Alright, so today we're going to talk about, again, cost volume profit analysis. We're going to switch directions just a little bit and talk about cost structure. And it's basically the trade-off between fixed cost and variable cost. So typically we call a company that has a high fixed cost structure capital intensive. It means they have a lot of machines, a lot of depreciable assets. Companies with a high proportion of variable cost we generally call labor intensive. Because labor tends to be variable. You're not focusing on machines as much. You're focusing more on the labor side, things that will vary as production goes up. For example, high fixed cost, capital intensive. Typically, you think maybe large airline, the planes. They're fixed cost. And really, their labor, primarily the pilots are paid salary, so you have a high fixed cost structure there, versus a fast food restaurant where they're highly labor intensive. They pay primarily direct labor, per hour, the hourly rates for the cooks, the counter workers. So when sales go down, they send people home, and so they can lower their costs. So they're a high proportion of variable cost. Operating leverage, then, is simply the extent to which an organization cost structure is made up of fixed cost. So high operating leverage means you have a high proportion of fixed cost. Low operating leverage, more flexible, you have a higher proportion of variable cost. Lower proportion of fixed costs. So what does all this mean? Well, if you have a high leverage, which means high proportion of fixed cost, it means break even will be high, because you have a lot of fixed costs you have to cover. So you have to sell a lot of items before you get that those costs covered. You also have a high contribution margin, because most of those costs you're covering are fixed costs. You have very little variable cost. So once you hit break even, if contribution margin is falling to the bottom line, you start making significant profit fairly quickly. Let's go up fairly quickly. Let's illustrate that. Firm, a high fixed cost. So yes, break-even point. So here's total revenue, here's total cost. Fixed cost plus variable cost. It takes a while to get to break even, because most of these costs are fixed. And so this line is fairly straight, just slightly goes up. There is some variable cost. But once we hit break even, the gap between total revenue and total cost starts opening up quite a bit. Now on the flip side, when sales start declining, the difference, your cost is going to be a lot higher than the revenue you're bringing in. So with a high operating leverage, we call that risky, because it takes a while to get there, to get to break even covering all those fixed costs. Now, the risk comes with the reward. Once you reach this point, the reward is greater profits. This is all versus a low leverage, which is high variable cost. Break-even point will be low. So will contribution margin. The low leverage firm, you can see compared to the high leverage, break even. Doesn't take much to get there. You don't have very much fixed cost to cover. You're hoping sales are higher than your variable costs, otherwise it's pointless going to business. But if you don't have very much fixed costs, it doesn't take long to reach break even. But since contribution margin is low, you're not really going to be making those gigantic profits like you would with a high fixed cost structure. But you're also not going to be losing much money in lower economic times. So when sales are down, you're not really losing that much. So that's the trade-off between fixed cost structure and a variable cost structure. Fixed cost structure is risky. And when times are bad, you have the potential for a lot of loss here. So that's why airlines started doing all sorts of stuff immediately when things started turning poor in the economy. But the payoff is in good times, things are really good. Variable costs, bad times, you're not losing too much money. It's easy to send those workers home. When you have a fast food restaurant, if no one's showing up, you only need one person there. But your payoff in good times isn't that much. So that's the risk reward in the trade-off scenario. So the idea is neither one is necessarily better than the other. You have to figure out, somewhat industry related, what works for you, how much risk you're willing to take. And depending on what you think sales are going to be, one's going to be better than the other for your company after you do that analysis. Okay? So any questions on that? So this is one of those profit analysis decisions, trading off between fixed and variable costs.